You just paid cash for a house and now you need your money back. Is there a solution? Well, my name is David Krasinski, and I want to take a quick minute here and explain to you that there is a solution out there, and it's called delayed financing, and I'm getting ready to walk you through how this works so you can better understand it. If you're an investor or if you're somebody that buys a house as a primary residence, you pay cash for it, and all of a sudden you determine that you need to get your money back, whether that is for another investment or for an emergency. So I'm going to walk you through what is delayed financing. Delayed financing is where a borrower purchases a subject property using cash, no mortgage. Once the home is purchased and the borrower meets all the requirements, they can get a cash out refinance on the same property to get a portion of their cash investment back. Now, typically a cash out refinance, you're going to have limitations on how much you can pull out, but normally you have to own the property for 6 months to be able to do a cash out refinance. In this case, with the delayed financing, you could do it right away. Now, here are some of the requirements. Property must have been purchased within the last 6 months. The original purchase was what's called an arm's length transaction. The original purchase is documented by a settlement statement which confirms that no mortgage financing was used to obtain the subject property. So you could use funds from a HELOC, you could use funds that you have in your brokerage account, whatever the case is. The source of the funds for the purchase transaction are documented. If it came from an unsecured loan or a HELOC, it has to be included in the debt to income ratio for the refinance. You typically have to pay those proceeds off. The new loan amount can be no more than the actual documented amount of the borrower's initial investment, including all closing costs. This is a Fannie Mae product, so you have to meet Fannie Mae's eligibility requirements, meaning that you're a natural person. If you have your property held in a trust, they're going to look at that. If it's a land trust, the borrower has to be the beneficiary of the land trust. Or if it's an LLC or partnership, the borrower has an individual or joint ownership of 100%. So if you have two borrowers on the loan, they both have to be 50% owners in that case. All other cash out eligibility requirements are met. And with this case, it says cash out pricing is applicable. So let me explain that to you real quick. When you have a loan and you're taking cash out, there's what's called a risk adjustment for that, because there's more risk to any lender when you do a cash out refinance versus when you do what's called a rate and term refinance, which means that you're only paying off the existing loan and not taking any cash out. So if you think about it, it makes sense, because on a cash out refinance, it's more risky to the lender because you're taking additional cash out. So there is a rate premium that gets added to that. So for example, like if your rate and term refinance is 5%, the cash out might be 5.125% or 5.25%, 5.5%, something of that nature, depending on the loan to value. And there are different loan level pricing adjustments for loan to value as well. So the higher you're going in loan to value, the more risk there is. Let's talk about the target audience for this type of product. It would be cash buyers. So if you're a real estate agent, you represent cash buyers, this is going to be useful for them. Or if you're an investor, this is going to be useful for you as well. Title companies can assist in this type of thing. And important information that you want to know about: funds can be used from a business account as long as the borrower is 100% owner of the business. Borrower or borrowers, if there's multiple borrowers, if you and your spouse are owners of a company. A lot of people want to know, how long does this take, Dave? So refinances take about 30 days to complete, although it could be faster. It just depends on the market. Could be a little bit longer if there's a big influx of loans, if rates went down or something of that nature. Typical is about 30 days. If you have questions on this, reach out to me. I mean, I'm happy to be a resource for you and help you understand this. If this is the right product for you, we can put together some information, see if it makes sense for you. Thank you so much for watching, and have a great day.